Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, we are from Group 7 of International Taxation, wants to present about methods for avoidance of double taxation in tax treaty. Before that, I would like to introduce our member of group. The first is Ananda Putri Nabila, and then Shaquila Dania, and me, Olivia Reynata Putri. The first problem is a tax avoidance based on OECD model will be presented by Putri. For Putri, time is yours.
OECD model, the history. OECD Ermansuri 1999 stands for Organization for Economic Cooperation and Development. The OECD was formed in the 1961 based on the Paris Convention, 14 December 1960, by member country of the Organization for European Economic Cooperation and Canada and the United States. The OECD model of double taxation agreement is prepared and developed by the committee formed by OECD country. The committee was specially formed to solve taxation problem faced by the OECD, the OECD Committee on the Fiscal Affairs. OECD model objective. First, to achieve the high sustainable economic growth, high employment opportunity, and ever-increasing standard of living in the member country, maintain monetary stability so as to contribute to economic development, to contribute to the expansion of the healthy economy, both in the member and non-member country, in the process of economic development, to contribute to the expansion of world trade on the multilateral basis that is not discriminatory in accordance with international obligation. OECD model concept. As an organization with developed country member, the OECD Committee on the Fiscal created this model aimed at solving international taxation problems that arise as the result of trade transaction between the country. In the principle, this model is intended for countries that are member of the OECD. Distribution of the taxation right. The article that regulate the country taxation right of the income are referred to as distributive rule or assignment rules, or also known as allocation article. In the general, the classification of income in the article referred to as distributive rule is as follows. First, active income is income that comes from business activities and work. Passive income is income that comes from investing in the form of the tangible and intangible property, including in the form of financial investment. Other income, this article regulates income that can be classified based on the above classification. The meaning of the terminology shall be taxable only in and the may be taxed in. In the tax treaty model developed by the OECD, the terminology used to state that the taxation right of the income is only given to the country, which is usually given to the country where the tax subject is registered as a domestic tax subject or resident state shall be taxable only in. Thus, if the taxation rights are only granted to one country, other countries are not allowed to impose tax. The terminology used to state that taxation right of an income are shared between the country of domicile and the such country is maybe taxed in. The meaning of the terminology is that the such country can also impose tax, thus in addition to the domicile country having the right to impose tax, the such country can also impose tax. Types of income tax article only in the country of residence shall be taxable only in Article 7, income type operating profit. The meaning of shall be taxable only in the relevant article, taxable only in the country of domicile unless the operating profit is obtained from business activity in another country, such country through a permanent establishment. Article 8, sea, river, and air transportation in the international traffic only taxable in the country of domicile on the basis of domicile of the management, except for profit originating from sea, river, and air transportation business activity which are solely carried out from and into the territory of another country. Then profit from sea, river transportation, and the air may be taxed in that other country or such country. Article 12, royalty, only tax in the country of domicile. Article 13, capital gain, only tax in the country of domicile on the capital gain subject to Article 13, paragraph 5. Article 14, professional income, only subject to tax in the country of domicile unless the individual who carry out the professional activity has a fixed base in the such country. Article 15, employee salary, only tax in the country of domicile as long as the employee is absent from the other country or such country for a period not exceeding 180 days within 12-month period beginning and ending in the relevant fiscal year. The remuneration is paid by an employer who is not a resident tax subject of the such country of income. The compensation is not paid in the such country by the permanent establishment of the employer. Article 18, pension, only tax in the country of domicile. Article 19, civil servant salary, only tax in the country of domicile. Article 21, other income, only tax in the country of domicile. Type of income tax that can be taxed in the such country may be taxed in. The following are the types of the income based on the OECD tax treaty model, where taxation rights are also granted to the such state, so that taxation rights are divided between the resident and the such state. Article 6, immovable property income can be taxed in the such country or the country where the property is located. Article 7, operating profit can be taxed in the such country on the operating profit attributable to the permanent establishment in the such country. Article 10, dividend can be taxed in the such country of domicile. Article 10, paragraph 1 and such country. Article 10, paragraph 2. Article 11, interest can be taxed in the country of domicile. Article 11, paragraph 1 and such country. Article 11, paragraph 2. Article certain capital gain can be taxed in the such country except for capital gain which are subject to Article certain paragraph 5. Only the country of domicile can impose tax. Article 14, professional income tax may be imposed in the such country if the individual who carry out the professional activity has the fixed base in the such country. Article 15, employee salary can be taxed in the such country as long as the employee is present in the such country for a period exceeding 180 days in the 12-month period beginning and ending in the fiscal year concerned. The remuneration is paid by an employer who is the resident tax subject of the such country of income. The remuneration is paid in the such country by the permanent establishment of the employer. Article 16, director salary can be taxed in the such. Article 17, artists and sportsmen it may be taxed in the such country on both the income received by the artist in the connection with the income from his performance as well as the income for the athlete related to the income from his competition. In the case when the country of income such can impose a tax, may be taxed in, the taxation right of income originating in that country can be granted by, first, without any restriction, unrestricted right of tax in the such state. This means that the such country can impose tax on the types of the income mentioned below in accordance with the domestic regulation without any restriction. For example, without any limiting tariff, the types of income are as follow. Immovable property income, business income, or business profit attributable to permanent establishment or BUT, capital gain, professional income received by individual, salary received by employee, director salary, the income received by the artist is related to the result of his performance, as well as the income of the athlete related to the result of his competition. And the second, with the restricted right of tax in the such state. This means that the such country can impose tax on this type of income below with the restrictions stipulated in the tax treaty. For example, based on Indonesian domestic regulation, dividend payment to foreign taxpayer are subject to a rate of the 20%. Then when the dividend payment is addressed to foreign taxpayer who has a tax treaty with Indonesia, the rate is limited to a maximum of 10%. The type of income are dividend and income.
Next topic is UN model will be presented by Kayla. For Kayla, time is yours.
Okay, for the UN model history, in the mid of 1960s, the United Nations started reviewing the problem of interest arising in double tax avoidance agreements. As a result of the increasing flow of capital from developed to developing countries. It is from R. Manchuri, 1999. Increased investment flows from developed countries too much depends on the investment climate in these developing countries. The prevention of international double taxation is a very important component in creating a good investment climate in developing countries. The existence of double tax prevention agreement is a full protection for people and companies that work or carry out business activities in various countries not to be taxed double. For the UN model on current life, the Secretary General of the United Nations established the first UN ad hoc group of tax experts with its members originating from United States, Argentina, Brazil, Chile, Philippines, Ghana, India, UK, Israeli, Japanese, German, Dutch, Norwegian, Pakistani, French, Sri Lankan, Sudan, Switzerland, Tunisia, and Turkey. Respective tax experts spoke to the group of tax experts in the capacity each person or in their personal capacity. Discussion results in the United Nations group of tax experts is the United Nations Model Double Action Convention between Developed and Developing Countries, or ALGN model, published by United Nations after 1980. After the issuance of the ALGN model, discussion and monitoring of its implementation is still being carried out by the tax expert group UN until now. For the article, the first is tax subject. The tax subject shall apply to persons who are resident of one or both of the contracting states. There is no difference between UN model and OECD model. For the second article, it is a tax type. The convention shall apply also to any identical or substantially similar tax which are imposed after date of signature of the convention in addition to or in place of the existing taxes. The competent authorities of the contracting state shall notify each other of any significant changes made to their tax law. For the fourth article is about the population. It means the place of incorporation. For further information, it is about the domicile of the company. For the fifth article, it is about the permanent establishment or BUT. It concludes buildings, construction, or installation project is considered a PE if it has more activities than 6 months. Next is the sixth article. It is about the immovable property income. To be taxed on immovable property is also an income from immovable property which is used for the implementation of professional service. For further information, profits for PEs are made clear, including if the parent company sells merchandise in other companies in other countries such as fees in other countries. The ninth article is about the relationship. The relationship is the existence of transfer pricing can evade taxes. The loser in this case is generally the source country because it is related to income or business circulation which is sometimes minimized. So the tax revenue is reduced. And the 10th article is about the dividend. Dividend taxation depends on the agreement between the two countries, generally lower than the OECD model.
Next topic is Indonesia's model will be presented by me. Indonesia's tax treaty. The Indonesian model is an amalgamation and development of two main models, namely the OECD model and the UN model, which were formed by and developed by Indonesia. Because Indonesia is a developing country, the principle is adopted in the policy in the field of double tax avoidance agreement is the UN model. However, it does not mean that all of provision in the model UN then used by Indonesia. The principle adopted is a combination of the UN, the main model, and the principles contained in tax law nationals. The combination between the two models produced a model called as the Indonesian model, which is used as the basis for implementing its double tax avoidance agreement negotiations, Surahman 2000. In Indonesia, P3B become part of Indonesia's taxation provisions through the stratification process, and his position is treated as lex specialis in respects of domestic law. For the policy, permanent establishments, to define this taxation right, Indonesia adopt a broader and more definition of PE according to the UN model benefits for Indonesia compared to the definition of PE according to the OECD model. The main difference is that according to the UN model, service delivery activities by residents of the country of domicile who are exercised in the source country may cause a permanent establishment in source country, depending on the duration of the activity. In other words, Indonesia's P3B policy regarding to the definition of permanent establishments places Indonesia as source country wishing to retain tax rights on business profits. Business profit. On the 59 P3Bs that have existed, 43 P3Bs are in accordance with the Indonesian model, namely adopting the principle of force of attraction income. With India, Mexico, and Taipei, the principle of force of attraction income is limited to the head of office profit that comes from sales of goods of the same types as those made by the permanent establishment in the source country, does not include profits from other head office activities. Next is capital gains. Indonesia's P3B policy for capital gains is in accordance with the OECD model, namely, first, the benefits obtained from the transfer immovable property may be taxed by the country where the immovable property is located, such country. Second, gains from the transfer of movable assets, which constitute part of the assets of a PE, including profits from the transfer of the PE itself, can taxed by the country where the permanent establishment is located, such country. Third is advantage obtained from the diversion of ships or aircraft operated in the past road international traffic or movable property. Related to the operation of the aircraft, it will only be taxed in the country of domicile. Fourth, profit from transfer of assets other than those mentioned in the previous paragraphs will only be subject to tax in the country of domicile, namely of the country where the person or entity transfer the property become its inhabitants. F. Other income. Indonesia P3B policy for taxation of income other than those already regulated specially in another article is that Indonesia only wants the lottery and prizes that can be taxed by the source country. In addition, taxation rights are given up to the country of domicile. UN model more dominant in filling out Indonesia's P3B, which can be said to be blessing in disguise because in fact, it is more profitable for Indonesia with the assumption that 90 Indonesia is mostly positioned as such country. Next is shipping, inland waterways, transport, and air transport. Policy for taxation of income from aircraft operations flying in international traffic is no different from the UN model and the OECD model, namely the right of taxation is transferred to the country of domicile, although this is different from Indonesia's domestic provisions. For the ship's operations, tax rate is 50% from tariff applicable taxes. Of the 59 P3Bs that have existed, Indonesia has only succeeded in winning the negotiation as many as 12 P3B. With the Philippines quite successful with the determination of the tax rate certain, with Pakistan providing no reduction in tariff and remaining 45, the P3B follows the OECD model. dividend interest and royalties corresponding with the UN model, namely giving taxation right to the source country with tariff restrictions, the amount of which will be determined by negotiations. All P3B Indonesia, except Saudi Arabia, conforms to the Indonesia model and with various tax rate restrictions, namely 5%, 10%, 12.5%, 15%, and 20%. If Indonesia positioned 17 himself as a capital exporter, Indonesia should fight for the limiting tariff as low as possible so that more taxation rights are shared with Indonesia. So also vice versa, if Indonesia positions itself as a capital importer, then Indonesia should fight for high restrictive tariffs. If Indonesia is an unclear position, the restriction tariff of 10% is moderate figure, which reflects the 50-50 division of taxation rights. Okay, thank you. That's all about our group presentations. Assalamualaikum warahmatullahi wabarakatuh.